Hey, this is Brian Kennedy, BKC Mortgage. I thought I'd put together a quick presentation for you on understanding seller concessions. And what I'm going to cover today in this short presentation is simply the difference between a temporary buy down and a permanent buy down, and the benefits for both the buyer and the seller are pretty tremendous. And when you see the math, I think you'll agree that this is something that you need to make sure that you're educating your buyers and your sellers about going forward in this marketplace. Listen, everybody, this isn't, rocket science here. High mortgage rates. The number one reason why we're using seller concessions today, and we're trying to educate everybody about them. Seller concessions can help solve the high mortgage rate crisis that we've been in for about 2 to 3 years now. Here are a couple solutions that are quite obvious, but we want to highlight them. Using seller concessions for a rate buy down. We'll talk about a temporary buy down and a permanent buy down and the benefits to the buyer and the seller on both sides of the equation. Solution 2, reduced upfront closing costs. Cash is king. You want to keep, if there's repairs potentially that need to be done on the home, negotiating seller concessions, not only just to buy down the interest rate, but to keep money in the buyer's pocket is a huge important part of negotiating seller concessions versus reducing price as another option. Solution 3, increased affordability. It just helps the buyer afford more of a home based on the higher interest rates that we have confronting us today. So for this example, we're going to use a purchase price of $550,000 with 10% down, and we're going to show you the difference between a temporary buy down, 2-1 buy down, and a permanent buy down. So for the sake of this presentation in this video, I'm going to use the most popular seller concession buy down that we get asked about, which is the 2-1 temporary buy down. It's the one that's kind of in the middle in between a 3-1 buy down and a 1-1 buy down. And basically, it's the most affordable and most beneficial for both buyer and seller. So a 2-1 buy down generally is going to cost 2.375% of the loan amount. So using the $550 purchase price, 10% down, a start rate, permanent rate of 6.875, and that's what we qualify. That's how we qualify the buyer at a 6.875 rate. Basically, it's broken down into a 3-year period where the first year you're going to be buying down the rate using the seller concessions 2 percentage points from that 6.875. So the first year the rate will be 4.875 using this example. Savings, $636 a month. That's monumental for buyers. Makes a huge difference. Much bigger than lowering the purchase price. Second year, we go up a percentage point to 5.875 and basically still a $325 savings per month. And then the third year, we're back to the original 6.875. And the strategy here is just this. The rates have been coming down. The strategy would be to refinance over the next 2 years to get them into a secured, fixed, low rate for the full period of the loan. So the strategy on a temporary buy down is always going to be that. I'll talk about the difference between a temporary and a permanent buy down and the strategies for a permanent buy down. But the temporary buy down is a temporary fix, hoping that the rates come down in the future, saving money up front, using the seller's money to do so. And it's a huge benefit for the buyer and the seller. So how does a permanent buy down compare to a temporary buy down? It's really just that. It's simply, are you more comfortable as a buyer with a temporary fix where I believe you're maximizing the amount that the seller is giving you to benefit you as a buyer on monthly mortgage payment and lower interest rate, both being paid by the seller. And that could be monumental and kind of change the dynamic of buying a home for many out there. Versus a permanent rate buy down, which gets you a fixed lower rate, lower payment. And as you can see, same parameters, same purchase price, down payment, same 2.375 percentage, 2.375% of the purchase price negotiated by the real estate agents to get from the seller to buy down the rate. We can still buy down the rate 1 full percentage point on a permanent rate buy down from 6.875 to 5.875. That will save that particular buyer about $325 a month for the complete 30-year fixed loan until the rates drop and we refinance them. Now, the difference between a temporary and a full is you're obviously seeing that you're not getting as low of an interest rate as you would on a temporary buy down. And that's just because of how it's structured. A permanent buy down is going to be more expensive to buy down the rate. So it's going to use up that money we have from the seller a lot quicker. So my advice would be, under the current trending conditions, is we're seeing interest rates get lower daily, weekly, monthly this year in 2025. And I would definitely educate our buyers on the pros and cons of both, show them the math, and then give my advice. I just don't want them to use the money for something that the market may give us in the near future. So show them the math, educate them on the process, and let them make the decision based on your advice. So that's the difference between a temporary and a permanent buy down. Listen, please reach out if you have any questions whatsoever about the difference between a permanent buy down and a temporary buy down. There are so many other things that we can cover, and education is always going to be our first priority. So hopefully this was helpful. Reach out if you have any questions. Make sure that you're seeing the math up front and you're getting options up front from whomever you're working with out there in the marketplace. We are here at BKC. We're all about upfront details, accuracy, accountability, and showing our buyers and our sellers all the options that they have to best benefit their family. Have a wonderful day.